Next, we are delighted to welcome a senior stateswoman in economic circles. Name a government office, and if it's in Washington and it has to do with the economy, Alice Rivlin has likely been in charge. She was founding director of the Congressional Budget Office. She was director of OMB and was former vice chair of the Fed. She's now at Brookings Institution. We've paired Alice with Financial Times columnist Edward Luce to talk about the state of monetary policy and what she'd do if she were still in government. Take it away.
Thanks so much. Disaster before I start. Alice needs no introduction, but I'll give a very. I'll give it. Yeah, you got one. I'll give a very brief reintroduction. I don't think there's any more any bigger Washington economic expert than you. You founded the Congressional Budget Office. You were the first head of it 40 years ago. One wouldn't have thought it. You were vice chair of the Fed, etc. All the sort of big, great and good positions that you can think of in your sphere. Now, you've been getting economic awards at roughly an average of once a week in the last few weeks from the Economic Club of New York most recently. And I've been reading the speeches of acceptance you gave, and you make the point that the issue everybody's interested in, which is when will interest rates go up, is the last thing you want to talk about. So let me annoy you a little bit by starting with not that question in particular, but the context for it, namely that we've had another year where takeoff growth has been predicted, but where the first quarter has been relatively disappointing, right. Not relative to other economies, but relative to what we were expecting for the US. The strong dollar has been a real drag on growth. Demand from the rest of the world has been in question and remains in question. So I guess what I want to ask you is this the right time to be talking about the Fed taking away the punch bowl?
Well, the Fed would love to get back to what they think is normal, a situation where they could get off this zero-bound difficulty and get interest rates up a little further to give themselves some running room. But the economy is not cooperating very well. And as you say, it has looked as though the recovery was gaining momentum. We've seen this for several years. It's not a bad picture, and probably will have stronger growth in the rest of the year than we had in the first quarter. But there's no inflation anywhere on the horizon. So the excuse for raising interest rates, except for the desire to get back to normal, seems a little thin. That doesn't mean they won't do it at some point. I think they would very much like to, but I'm not clear when that will be.
Why should they want to? I mean, inflation's clearly yesterday's battle, right. Except in the sense that it is a problem today in that it's too low. It's too low here, it's too low in Western Europe.
That's right, and that's not a reason for raising interest rates.
And it's not a reason for raising interest rates. Is it a reason for raising inflation? Should we be thinking of sort of using other instruments to get demand up and keep it up?
Well, the Fed has used all the instruments it has, really, to keep the recovery going and to be accommodative in every sense. So the other instrument that hasn't been used well.
Do you think this is me?
I don't know.
Carry on.
The other instrument that has fallen into disuse, really, is fiscal policy. We used to think of fiscal policy as a very useful instrument in the... Should I take that off? We used to think of fiscal policy as the other instrument besides monetary policy that helped to smooth out the business cycle. And the fiscal policy was particularly helpful when you wanted to get the economy going faster. Monetary policy was particularly helpful when you wanted to slow it down. We know that works. Monetary policy has never been very good at stimulating growth. Right now, I don't think is the moment for stimulus, but it should be the moment for using the federal budget to
increase the chances of growth in the future. Because, as you said, not only are the growth forecasts pretty low for the immediate future, but we and other developed countries are facing a possibly low growth scenario for quite a long time. And one thing we know is that our infrastructure is crumbling. We need to do something about it. It would help our long-run productivity prospects if we could invest sensibly in all kinds of infrastructure, including transportation and broadband and so forth. So I would hope we could do something like that. But I'm a fiscally responsible person, so I would like to do it in the context of stabilizing the debt and getting it coming down in relation to GDP over time.
So we kicked off this morning with Larry Summers, and in the context of the fact that we've got, in long-term, 10-year cost of borrowing at below 2% across the Western world, and in some cases below 0%. Do you accept his thesis that we're going through something like secular stagnation, that there is just no returns to investment available, and that monetary policy is going to have to remain extraordinary and unusual for a long period of time? This isn't just a blip.
I don't like to call it secular stagnation because I don't believe in secular anything. I think the economy surprises us very often, and anybody who says, I know how it's going to be for the rest of time is courting disaster. But I think Larry's right, and the IMF is right, and others are right, that the prospects for strong growth in the developed world are pretty weak at the moment for various reasons. Population growth is coming down. It's quite negative in some countries. Ours is better. And potential growth is being revised downward everywhere. So I think it is likely that quite accommodative monetary policy, meaning low interest rates, will be appropriate for some time.
But you don't think that there's a broader structural problem there with future growth in the West, in the developed world? You don't think there's something bigger going on here?
I don't know, and I don't think anybody else does. That depends on what the next new thing is, and we've been surprised by new things that come out of, apparently out of nowhere. We're a very inventive entrepreneurial economy, and I wouldn't give up on us or anybody else.
Let's talk a little bit more about the Fed as an institution. Clearly, like in my own country, the Bank of England has become the chief financial regulator in the last few years, since the crisis. The Fed, to some degree, has. You've got FSOC, the Stability Council, that's been set up under Dodd-Frank. But we've still got this balkanized regulatory system in place here. Now, if, as you say, and as you've said with some of your recent acceptance speeches, the Fed's real challenge isn't defeating a non-existent inflation. The Fed's real challenge is preventing another financial collapse, is stopping financial instability. Do you think it has the tools to do that under the Dodd-Frank reforms, or do you think more needs to be done?
I think Dodd-Frank was a step in the right direction, and you're absolutely right that I feel very strongly that financial stability or financial instability is the biggest threat that we have to a continued broadly shared prosperity. We can't do 2008 again, and I don't think we should relax about that. We do have new tools in Dodd-Frank. They're untried tools, but they are the right things. We have put more clout in the regulators. We have given them, we have raised the bank capital requirements, and we've done things about excessive leverage. These are tools which can be used. We haven't seen whether they will be used. It's still true that our regulatory system is very fragmented, and we saw in the run-up to the financial crisis that financial institutions are very good at finding the weakest regulator. So I think we need to consolidate prudential regulation. Paul Volcker and the Volcker Alliance have a very interesting and I think quite bold proposal that came out on Monday, and I commend it to you. You can find it on the Volcker Alliance website. Full disclosure, I'm on that board.
Is there a board that you're not on, Alex?
Oh, yes.
Well, there is. There must be one or two.
But the Volcker Alliance proposal does consolidate prudential regulation of major financial institutions, in fact, of all financial institutions that are federally regulated, under the Federal Reserve's new vice chair for financial regulation. Now, you may say, who is that? This is a position created under Dodd-Frank, but not yet filled. I think that's a sensible thing to do, but it's not going to happen quickly.
The focus has been on systemically big, important institutions, the too big to fail institutions, but just in the last day or two, a 36-year-old small-time crook from Hounslow, West London, has been indicted.
You can't trust those Brits.
That I can attest to as well. But this is a lone wolf of a very unidentifiable or unforeseeable nature. One guy in his parents' semi-detached home, can bring the Dow, can collapse the stock market by very clever algorithmic sort of trading methods that exploit informational advantage in milliseconds. This isn't he's too small to jail. He's too small to fail. Nobody saw him coming. Are we sort of unaware of where the threats are coming from? Are we actually, like we were in 2008, ignorant without realizing we're ignorant?
Well, we have to watch out for that, I think. That's the big question. All of this innovation in financial instruments and in technology has made our very interconnected financial system much more vulnerable. And we found out in 2008 that it wasn't just big banks that could give us trouble. It was investment banks that were not very huge or very well regulated. And so we aren't sure what the surprises are. But focusing the attention of the Federal Reserve and the other regulators on this problem and continuously focusing on it is, I think, what we need to do.
Of course, FSOC, this grand, untested, as you say, new sort of oversight board chaired by the Secretary of the Treasury, only has jurisdiction over systemically important holding companies, not shadow banking, not the sort of areas of the economy that elude that definition. So what you're recommending, and what I understand Paul Volcker is recommending, would be to include all of that. If I'm correct, that it would be a far more general, all-purpose remit that you're seeking for proper regulation.
Well, it doesn't abolish the FSOC. It strengthens it, actually.
It strengthens.
And keeps the Secretary of the Treasury as the chair. But it does also strengthen the Fed and puts prudential regulation all in one place under the Fed.
All in one place.
Yeah.
So that leads on to my next question, which is about campaign finance reform. Now, I know you feel passionately about this. We're at a situation where a handful of individuals might be getting first take on deciding who the next president's going to be, more so than in previous cycles. But we're also in a situation where we're no longer in a panic about the financial markets. They're no longer on the front pages. I don't think the Volcker report was really covered yet. It's so far been covered to any extent anywhere. A few years ago, it would have been covered. And the amount of money spent on lobbying in this town and regulator shopping is just as big as it's ever been. I know you feel passionately about campaign finance. It strikes me, though, that it's even more academic, in other words, hypothetical, unlikely to happen, than another Dodd-Frank that gets it right, that takes yours on Paul Volcker's advice. So just to play devil's advocate, you might be saying the right things, but is there a hope in hell any of them are going to be adopted?
Oh, you could say that about a lot of things. I'm for a grand bargain on the budget, too. That's not going to happen tomorrow. But I think the influence of money in politics is excessive. I'm not a lawyer, but I don't like the idea that money is the equivalent of speech. It would probably take a constitutional amendment to turn that around. And although I feel passionately about it, you're absolutely right. I don't think it's going to happen anytime soon.
But do you think that the kinds of things you're recommending can happen unless we change the role of money in politics? I mean, what's the way of getting around the financial sector's very intimate involvement, not just with legislation, but with oversight, the congressional oversight of the regulatory agencies and the rule writing that the agencies undertake?
Well, I don't expect that any industry is going to welcome more regulation, and I don't think we're going to have another review. We just did Dodd-Frank, and we haven't finished the regulations under Dodd-Frank yet, so we're probably not going to open that one up very soon. But I just think we have to keep our eyes on this problem that we can't get complacent about the fact that it's quite likely that at some point we're going to have another financial crash if we aren't very, very vigilant. So I think we should be very vigilant. And part of that is the Congress and the President coming together and saying we need to be really vigilant on financial oversight, and we can't let the influence of those who are being regulated and whose profits might be down because of regulation to turn that around.
Now I'm going to move to questions in a minute, but let me just ask you before I do so, if you were Janet Yellen, what would be keeping you awake at night right now? I mean, apart from everything, what specifically?
Well, I'm very fond of Janet, and I'm glad I'm not in her shoes at the moment, though I think she's doing a great job. I think I would, of course, be worrying about when the Fed should raise interest rates, but I don't think it should be keeping her awake at night. The harder questions are the ones we've just been talking about. How should the Fed help identify the threats to financial stability? What sort of powers do they need? How do they cooperate with other regulators? And how do they make it real?
Thank you. Let's go to questions. I don't know who's got the mics, but please show your hand and please ask a question rather than issue a statement. Yes, right at the back there.
Hi. Yes, regarding the powers of the Federal Reserve, a lot of the Fed bank presidents have said and implied that the federal funds rate maintaining between 0.25% since 2008 has sort of run out its ability to stimulate economic growth. Do you think that we should return the Fed's ability regarding its powers of Section 13 and its discount functions to a more progressive era of the Fed where it aids the general commercial banks to regain stimulating the economy with loans to small business?
I wouldn't take that on right now. I don't think it's a necessary part of what the Fed needs to do. It's doing its part in trying to keep the economy, the recovery going, and I wouldn't advise anybody to try to get new powers at the moment.
So before we go to the next question, that does remind me of a question I did want to ask you about the Fed's political independence. Now, in the past, you were saying that you felt the threat came more from the left, from populists on the left. Now it's more from the right. How do you see that unfolding in terms of the Audit the Fed politics we're seeing amongst Tea Party Republicans? Is that a material threat, or is this just noises off?
I don't know, but I think it is a shift because historically there haven't been really serious threats to the independence of the Fed. There was always a group, mostly on the left, mostly populist Democrats from the Middle West, who worried that the Fed would raise interest rates too high. If you're in agriculture, you don't want high interest rates. And that was the historical movement, going back to William Jennings Bryan. And they persisted. But now there are those on the right that are worried about the independence of the Fed, and not so much in the interest rate developments, but much more in the new powers over regulation and systemic risk. So I think that there's something to worry about here. Audit the Fed is a misnomer. The Fed is, of course, audited in any usual sense. It is having a report to the Congress on monetary policy. I'm not sure that can do an enormous amount of harm. I don't think the Congress wants to make monetary policy. It's too hard. Better let somebody else do it. But I do think it's not a sensible thing to do.
Well, one of the most enjoyable things is watching Janet Yellen take questions from people in Congress and maintain her politeness in answer to the kinds of questions. But President Rand Paul wouldn't be one of the things that Janet Yellen, in terms of her long-term nightmares or daymares, should be keeping her awake.
If that's asking for a prediction about Republican primaries,
No, a hypothesis.
Hypothesis of a President Rand Paul. He's a very smart man. I think he would figure out that is not something he wants to make a primary campaign issue.
A good dodge. Sorry. Next question, please. Yes, gentleman towards the back. A mic's coming.
All right, great, thanks. You talked about financial instability without talking about, I'm wondering what your opinion is on the fact that a $14 trillion loss was caused, but none of the individuals at the financial institutions have gone to jail. So does this not send the signal with respect to financial stability that you can destabilize an economy and not, you can pay a fine, but not pay a personal price in terms of jail time?
He's mentioning the fact that nobody's actually gone to jail because of 2008 and how much of a...
Well, I think our legal system was a little slow on getting on top of that, but they had the rescues were fast and furious, and yes, I think there have been heavy fines, there have been signals sent, but nobody has gone to jail. I don't think that's something we can change in retrospect, but maybe it sends a bad signal.
I'm guessing that the guy from Hounslow is heading straight for the clink, but that's a prediction. Next question, please. Was that a raised hand, or were you just you're eating? Oh, the last question. The lady in the front at the front table. Just wait for the mic.
Hi, Kathleen DeBoer from the OECD. Just to follow up on the Rand Paul question, when he talks about auditing the Fed, is he not more concerned with taking a look and having more Americans understand all the troubled assets and such that they're holding on to, rather than just actually setting monetary policy?
I don't actually know what Rand Paul has in mind when he says audit the Fed. The earlier versions were actually his father's intervention did have to do with monetary policy, but so I actually just don't know what he has in mind. But I do think monetary policy is not something that the Congress wants to set itself.
I think there is a perception, though, rightly or wrongly, that in the public at large, that there are a lot of toxic assets on the Fed's balance sheet, and that unwinding them might be problematic. I guess that's...
It might over time, but toxic assets tend, with enough time, to detoxify. The famous Swedish bad bank actually made money in the end.
Right. A good answer. Thank you so much, Alice, for taking all those questions.